2024 was the year for tech and startup IPOs in India.
The IPO boom in the country.
India's largest IPO.
India's largest IPO.
The largest IPO in
The largest IPO India has.
2 lakh crore rupees of new market cap that was added. That's about $25 billion. And these companies raised approximately 25,000 crore rupees. In May 2024, TBO Tech, a travel tech company, raised 1,550 crore in its IPO. In June 24, Ixigo raised 740 crore. Ola Electric went public and raised 6,150 crore. After that came First Cry, followed by Unicommerce. November was the month where Swiggy went public. We'll walk through step by step from when a company makes the decision to want to go public. We'll look at what is the impact of companies taking longer to go public. We'll then analyze the key takeaways from the Blume Ventures report on main board IPOs in India. And there are a lot of misunderstandings around what happens in an IPO. This is a short report from the Indian venture capital firm Blume Ventures, which provides a lot of context on what has happened in the last 10 years in the world of Indian IPOs and what's going to happen next. Let's get right into this week's breakdown. Before we go to the next part of this video, I'd like to give a shout out to Zerodha, and they provide us with the resources to do the research and to produce this high quality video content for you, the audience. I can honestly tell you that this video would have not been possible without their support. The video is recorded purely for educational and informational purposes only. This decade seems to be like the Indian tech IPO bonanza. From 2021 to 2023, these startup and tech companies raised about $6.5 billion in their IPO. In July 2021, Zomato went public and raised 9,375 crore. Zomato's IPO was followed by CarTrade, which is a car listing and auto platform, which raised approximately 3,000 crore in its IPO, which took place in August. After CarTrade came Paytm, which raised 18,300 crores in its IPO in November. And after the Paytm blockbuster came Policybazaar, whose parent company PB Fintech went public in the same month, November, and raised 5,600 crores. Nykaa's IPO in November 2021 raised 5,300 crores. There was a bit of a pause in May 2022. Delivery raised 5,200 crores, and in November 2023, almost a year and a half later, Honasa Consumer, whose brand Mamaearth you must have heard of, raised 1,700 crore in its IPO. And the answer to what's going to come in the future lies in the pipeline of companies which are going to go public. Starting with e-commerce, we have Zepto, Meesho, Flipkart, and Ecom Express. In consumer, we have Oyo, Ola Cabs, Car Dekho, and Grow. In payments, we have Razorpay, PayU, PhonePe, Pine Labs. And in B2B, which is business marketplaces, we have Off Business and Infra Market. To understand why there is this IPO bonanza which is happening in India, we need to look at a little bit of history of the Indian venture capital ecosystem. Now, initially, most of the funding that was available for startups was being provided by the Indian arms of foreign venture capital firms. And because of this, quite a few Indian startups, including the one that I had started in 2020, would end up being incorporated outside of India. So the holding company is located outside India, but the operating company, which would hire the employees, which would do the sales in India, would be based in India. Now, over time, this has started to change as more Indian venture capital firms have emerged that are raising money domestically. And a lot of the previous generation of Indian technology startups, which were incorporated overseas, are doing something called an ownership flip. Doing an ownership flip makes your Indian operating company the parent company. I won't say it's a requirement, but it's ideal to do this if you are going to go public in India. When we look at the number of prominent Indian startups that are in the process of this ownership flip, it is just going to blow your mind. There is Razorpay, Pine Labs, Grow, Flipkart, and Zepto. There are also very, very valid reasons as to why Indian startups are moving their ownership to India. The first reason is that there is a lot of regulatory tailwind to make the process of doing this ownership flip easier. So in September 2024, a regulation was passed which removed the NCLT, which is the National Company Law Tribunal requirement, to be able to do the ownership flip. By removing this NCLT requirement, the time taken to do the ownership flip will reduce by about 6 months, but it doesn't change the cost of doing the ownership flip. And to give you an example, Grow had to end up paying approximately 1,400 crore to the US government to change their ownership from Delaware in the USA to India. The next reason why we're seeing a lot of Indian startups move their domicile to India to do the IPO is that honestly, tech IPOs in India are being very, very well received. Technology companies typically have multiple years of heavy burn when they are investing in forward growth, and when these internet or these technology companies start to turn profits, it's almost like someone opens a tap and money just flows out. So India as a market is now opening up to long gestation period to profitability followed by very generous profit, and this will play out over the next few years. We also have 25,000 crore rupees of SIP from investors like you and I that is going into our market. The final reason is just because the US market has some unrealistic expectations from a company in order to IPO. And I'm going to give you a few data points from the Meritech 2024 blog on US IPOs. Typically, the expectation for a company in the United States to go public is that it needs to have $250 million of annual revenue, a 40% annual revenue growth rate, and a criteria called the Rule of 40. The Rule of 40 means that your revenue compound growth rate as a percentage plus your profit margin as a percentage should exceed 40%. Now, if you ask me, this is like unrealistic expectation for a company to go public in the market like US. But on the other hand, in India, the bar for doing a main board IPO in India is quite low. Now, I want to take a minute to tell you about the impact of delayed IPOs. To answer this, let's rewind the clock to before 2000. Amazon was founded in July 1994 and it went public in May 1997. Less than 4 years to go IPO. And let's take a second to look at what happened to Amazon post IPO. So the Amazon share price at IPO was 8 cents. It's $200 today. That's 2,500x return over 27 years. But I want to now tell you Amazon versus Google. Google was founded in 1998. It IPO'd in 2004, exactly 7 years after Amazon. Amazon's market cap at IPO was $300 million. Google's market cap at IPO was $24 billion. If you take a step back, you can already start to see what is happening. The period or the time it took from founding to IPO was starting to elongate. The valuation at which the company was going public is also starting to increase. And there is a very important point to highlight. Because startup and technology IPOs are now being delayed to further in the company's life cycle, you as the retail investor have to pay a much higher price to buy this share. So you're entering this company at a much higher valuation. The companies are of course much more stable, but the probability of you just hitting a 10, 100,000 bagger post the IPO in some of these startup and tech companies is now very unlikely. Now, the impact of startup and tech companies going public much later is that family offices, ultra high net worth, and in some cases individual investors are also now starting to shift their focus from just doing public market investing to also doing private market investing. Let's look at some of the data from India. Altiria Capital, an Indian venture debt firm, raised 1,550 crore Fund 3 entirely from domestic investors. Let's look at equity investors. Blume Ventures has said that 40% of their 2,500 crore Fund fund for has come from domestic investors. And this just goes to show that this shift to alternatives or the shift to private markets is happening, and it's happening fast. We spoke very briefly about main board IPOs, which is the typical IPO that you have heard about. There is another class of IPOs called the SME IPO, small medium size enterprise IPO. In 2012, the SEBI introduced regulations for the SME IPO. Bombay Stock Exchange launched their SME platform in March 2012. National Stock Exchange followed in September 2012 to launch NSE Emerge. There were 14 SME IPOs in 2012 and there were 226 IPOs in 2024 on the SME exchange. A company that does an SME IPO has an opportunity to migrate from the SME to the main board. The average fundraise done in an SME IPO is 31.65 crore. And this, by the way, folks, is also why you see an SME IPO being so heavily oversubscribed. And the concept of SME IPOs are not unique to India. It is a global phenomenon as well. I want to take a minute to tell you the story about one SME IPO that is just going to shock you. The company's name is E2E Networks and it is a cloud and data infrastructure company based out of India. On 15th March 2018, E2E Networks went public by doing an SME IPO. E2E was valued at 80 crore then. Now, pay attention, 57 rupees price per share in 2018. Here's the fun part. In November 2024, E2E exchange share price was 4,200 rupees. And therefore, the message that I'd like to share with a lot of the viewers here is that there is a lot of news circulating that SME IPOs are fraud, SME IPOs are scam, there is no diligence done in SME IPOs. I do agree with you that because the issue size is so small, that the chances of there being financial oversight, fraud, etc. is higher, but there are stories that show that you can begin life as an SME, transition to the main board and generate almost life-changing returns. Not financial advice, but just a story to share with you. How does an IPO work? There are 14 steps involved in an IPO, and let's go item by item. The first step of the IPO is for the board of the company to pass a resolution to convert from a private limited company to a public limited company. And this decision is very critical because once a company makes this switch, there is now no restriction on who can start to buy shares in the unlisted grey market of the company. Next up, there is appointment of intermediaries. And trust me when I tell you this, the number of people that are involved in an IPO transaction are large. You have everything from a PR and comms agency that helps you publish material about the IPO for the general public to advisors who will sit with you and help you pitch to institutional investors. So next step, appoint your intermediaries. After this comes the preparation and filing of your draft red herring prospectus document with the SEBI. Draft red herring prospectus is a document that at a very high level explains what business your company is in, who your promoters are, what the history of the business has been, what has been the financial performance, what is the opportunity that lies ahead for the business, what are the risks involved in the business, how much money are you looking to raise, and why are you looking to raise this money. The next step is for SEBI review and approval. While the filing of your draft red herring prospectus takes 2 to 4 months, the SEBI review, which comes next, and their approval takes anywhere from 2 to 3 months. At this point, once the SEBI approval comes in, there is an action which is converting preference shares to common shares. Quick understanding on this: when a venture capital or private equity investor invests money into your company, they buy a different class of shares called preference shares. And in the event the company doesn't succeed, the typical idea is that because a preference share has a preference over a common shareholder, they get paid first. Once the conversion is done, you need to get approval from the stock exchange. NSE and BSE actually need to go and do the diligence to make sure that this company that is filing for an IPO is legitimate or not. Once you get approval from the stock exchange to do your IPO, you start to finalize the fine details about your IPO, like what is going to be the price band per share, how much are you going to allocate to different classes of investors. So how much is available for your anchor investors, how much is available for qualified institutional buyers, the amount that is available for your high net worth and ultra high net worth investors, and the amount that is available for the general public to buy. So once these finer details are locked in, which would typically take 3 weeks, you begin the part where all of us come to know about the IPO. You will start to see information about the company be made available in the public domain. This is the marketing roadshow, which lasts 2 to 3 weeks. And one caveat to highlight here is the marketing roadshow is not geared at you and I, the retail investor. It's actually geared at the anchor investor and the qualified institutional buyer. Next is the anchor investor allocation, which is just your largest investors deciding how many shares they'd like to buy. Finally, the IPO opens for public bidding. Then you have something called the book building and price discovery process. The simplest way to understand this is that you just take some time to see how many people are interested in subscribing, does the price hold, and where does the price ultimately land. Now, in my own experience in the last couple of years for your bigger IPOs, the IPO subscriptions have always been executed at the top end of the share price band. Then the window for you applying to the IPO closes. Once the bidding closes, you can no longer see the option to apply in your Zerodha app. The next step is the allocation of shares. Quite often IPOs are oversubscribed, and therefore there is a registrar entity like KFin Technologies that does the job of matching who is allocated these shares. And this is when you get those regret or those success emails saying that your shares have been allocated. Once this allocation is done, a few days later you would have the company going public. In the case of a main board IPO, you would see the bell being rung, and that's the IPO process. 14 steps. It can take anywhere from 6 months to 18 months and even more than that for this company to go public. Now that we have a slightly holistic picture about IPOs, I think it's a good time for us to look at some of the facts and figures that are provided by Blume Ventures in their report, Insights from a Decade of Main Board IPOs. Let's get into it. I think one of the most interesting takeaways from this Blume Ventures report is that 67% of the capital that has been raised by IPOs in the last 1 decade has been an offer for sale. An offer for sale is when either the promoter or private investors in the company are selling their shares to the general public as part of the IPO transaction. 67% is promoter offer for sale, 33% is primary capital. Now, going back to something that we had commented on, because companies, startup and tech or otherwise, are staying private for much longer, their new capital requirement to invest in working capital or in capex is much lower, and therefore their often reason for going public is to provide an exit to investors or to provide partial or complete liquidity to one or more of the promoters. And therefore, when you look at the pie chart, you will see that 33% of capital is for primary purposes like capacity expansion, working capital requirements, etc. 27% is to provide investors with an exit, and 40% is to provide the promoters with either liquidity or an exit. Another interesting fact in the Blume report is that typically the IPOs that have happened in the last 1 decade have happened at a 24 price to earnings multiple. The next takeaway from the Blume Ventures report is the time to IPO. So on average in India, it takes 23 years for a company to go public. But the interesting insight from the Blume Ventures report is that the number of companies that are going public with less than 10 years since founding is steadily increasing. The third takeaway from the Blume Ventures report is that we are starting to see more IPOs but smaller IPOs. The average over the last 10 years of capital raised by a company which is going public has been about 1,300 crore rupees. For 2023, it was about 850 crores, and for 2024, it was about 1,100 crores. So we're seeing more but smaller IPOs. The fourth takeaway is honestly going to blow your mind, and this is that you have to pay to raise money. An IPO which has 14 steps involved is obviously going to cost you some money. Blume Ventures has given us a quick summary of what are the various expenses that a company incurs in the process of going public. there are fees that need to be paid to the underwriter. The underwriter is the firm that is guaranteeing that if the public and other investors do not fully subscribe to the IPO, they will buy all of the unsubscribed shares. There are marketing and promotion costs, there is cost of compliance, and there is cost of consultants. What we know based on the Blume Ventures analysis is that if a company raises 1000 crore in its IPO, it spends anywhere from 30 to 80 crore in all of these expenses in order to raise that 1000 crores. Let's look at some examples of how much it costed for the IPOs to happen. Paytm raised about 18,000 crore in its IPO, and the cost of doing the IPO was about 400 crore. Zomato raised 9,300 crore in its IPO and incurred about 280 crore in IPO expenses. Now, we've discussed at a high level that 33% of money raised in the IPO is for primary purposes. Let's try to understand what is that 33% of capital actually used for. And there's a very good slice in this report that explains to you that as the company's size grows, the purpose for which that 33% of primary capital is being raised also starts to change. So for your smaller firms, which raise about 100 to 150 crore rupees, the primary purpose of them raising the capital is working capital and capex. When you go to mid-size firms that are raising 200 to 400 crore in their IPO, is debt repayment. And when you get into the 400 to 1800 crore IPO range, a significant portion of the fresh capital that is being raised is allocated towards M&A. And when you think about this, it makes perfect sense. If you're raising a small amount in your IPO, it's quite likely that you're a younger, slightly less mature company, and you would need that money so that you can grow your business. When you're a mid-sized firm, it's quite likely that you've already incurred a lot of the capital expenditure to build out your factories, build out your facilities, and you are now in the mode of arming your existing facility for cash flow. As a mid-sized firm, you would have probably already raised some debt in the past, so you are now doing this IPO to pay back that debt and clean up the structure of your business. When you are a larger firm, you need to unlock new avenues for growth so that your company can continue to expand and be an exciting prospect for investors. So as a large firm, you would do an IPO so you can keep money aside to find very interesting tuck-in acquisitions, which is businesses that are adjacent to your core business, so you can expand your product suite. And that's all for our video on IPOs on Breakdown. And I want to close with a very interesting comment that I have heard Abhishek Goyal from Traction mention. In Abhishek's own words, I spoke to 100 people before deciding to do the IPO. 97 out of 100 said, don't do the IPO. 3 out of 100 said, do the IPO, and all 3 of those were CEOs of publicly listed companies. That's all from us. See you next time.